Emerging markets are soaring. The benchmark MSCI index posting its biggest four-day gain since 2009. There's the one-week chart for you, but are there other opportunities like Chile, Indonesia, and Thailand? Rob, you say yes to all of that.
Yes, I do. We're still in the middle of a secular bear market here in the U.S., and we believe there's another 10 years or so of this amazing volatility. So we want to go where the growth is. We see GDP growth around 2% in the U.S. Well, what about places like Indonesia and Chile and Thailand? That's where the growth is actually happening. They're taking our free market ideas and they're running with it.
But how do you do the investments? Do you recommend, do we go stock specific? Do you do like U.S. multinationals investing in those countries? Or would you say maybe do like an index like an MSCI, one of the breakaways of the MSCI, or would you do an ETF? What would you do? So
there's all kinds of ways that you mentioned. I think the best two are buying multinationals that have exposure, and also sector-specific ETFs. So
ETFs, sector-specific.
Sector and country.
Okay.
Yes, exactly.
So give me some names with that.
Well, I can't give any specific names, but I can tell you like a couple of sectors. Indonesia, an example, or you could look into Brazil too. Chile. Chile is the largest copper producer in the entire world. So you can buy ETFs that gives you exposure to that.
Like an energy ETF, just like a generic energy ETF, or?
No, you can actually get so specific. You can say small caps in Brazil, as an example, if you believe that the small caps are going to do well.
Okay, so you like emerging markets, you like natural resources, you like hybrid annuities.
Yes.
So maybe under the second, broad-based investments overseas with emerging, but then with natural resources, that's also where you could get specific on ETFs, correct?
You sure can. You sure can. You can do ETFs, or you can actually do direct investments into natural resources like oil and gas, and you get tax write-offs and good cash flow that way as well.
Okay.
You don't worry. We read these terrible stories in China about factories that end up emptying out and you didn't even know it, about companies that supposedly own lots of forests that they don't really own. Chile, Indonesia, Thailand, are they any safer, better off, better accounted for than China markets, or worse?
Then that's why you want to use an ETF or a fund approach.
Spread out that risk of accounting downside. And also, I noticed you didn't mention Brazil, and yet I think Brazil is one of the best places because it's got a continental mass the size of the U.S. Half of its 200 million people are already in the middle class, and another 50 million to join in the next 5 years or so. Do you like Brazil?
I do like Brazil. I also like the debt of Brazil, bonds that are issued in Brazilian real currency as well. So you also get, not only you're buying bonds at a cheaper price than here in the U.S., but you're getting a better yield, and you get diversification from the U.S. dollar.
And if I think the U.S. dollar is going to weaken and weaken and weaken, that would get hurt by that or helped by that?
If the U.S. dollar weakens, you actually get helped by
Brazil holdings would be fine.
Yes.
Oh, okay. Liking that.
Before we let you go, I do want to ask you, what did you make of the Fed's move yesterday?
The Fed's move was interesting, and I don't believe it was by accident. I think there was, to be conspiracy theorists, I honestly believe that there was a very valid concern that there was going to be a bank failure somewhere in Europe, a large bank failure, and they all rushed to do this and inject liquidity. But it's not going to solve the long-term problem of the debt.
We saw the dollar get crushed yesterday versus the euro.
I just want to counterpunch with something here and just point out that other people are saying in the markets, financial advisors. One guy told me, look, everyone's saying that the fear of a bank failure. This is not it at all. He said this is about one thing, he argues, Germany's bond rate versus the U.S.'s. And Germany have been trading, you got less interest because Germany was seen as more safe. And only in the past 30 days, suddenly it blew out, and you were paying far more for German. They saw German as more risk. And this guy insists that they needed to just balance Germany as the power in Europe and U.S. on our side and get that spread down. And it's come down some since that happened yesterday.
Right. Rob, interesting strategies. And we're going to talk more about your strategy later on.
Great.
I'm going to get into the whole endowment story with you.